Welcome to Online Trading Campus. This is Jan Skoropinski with you today, continuing the new 2021 stocks course. Welcome to Lesson 3, Market Timing Tools for the Long-Term Investor. Since we're all a little worried about bear markets and market crashes, let us take a look at some fundamental drivers for stocks to really be able to time markets, bottoms and peaks, not only based on supply and demand and cycles like we discussed in the previous lesson, but also based on fundamentals. In the previous lesson, you've learned some fascinating cyclical patterns in the stock markets that are indicative of what is happening in the future, when to expect major rallies or declines in the financial market. This was your first layer of market timing, if you will. In this lesson, we're going to add another layer. I call them the underlying fundamental conditions. Ideally, the cyclical patterns should be supported by the underlying fundamental conditions of the economy. This is the agenda for today. In this lesson, we will look at the Fed and market timing, inspect the conditions for tops and bottoms, which helps us to understand better what to look out for. Then I will introduce the anxious index, a further deep dive into the yield curve, and trust me, there will not be any repetitions in this course on the yield curve, only additional building blocks. We will look at the employment trend and a technical indicator called the Campus Buy Signal, which we developed for this course. Without much further ado, let's get straight into it. We have all heard the phrase before, market timing does not work. And it is very clear to us why Wall Street wants us to buy into that notion that it is impossible to time the markets. Of course, you guys and I, we beg to differ and strongly disagree with that idea, as we can time markets. And guess who is on our side here? Our dear friend, the Federal Reserve, who we know by now is the biggest and most influential participant in the financial marketplace. Now, since we are always interested in what the biggest, most influential institutional participants are doing in the market, wouldn't it also help to understand fundamental indicators the Fed looks at and operates under? Well, of course. Here you can see a screenshot of one of the papers released by the Federal Reserve with the headline, Market Timing Strategies That Worked. This paper is clearly about market timing. The abstract reads, I quote, "In this paper, we present a few simple market timing strategies that appear to outperform the buy and hold strategy, with real-time data from 1970 to 2000. Our focus is on spreads between the EP ratio of the S&P 500 index and interest rates. Extremely low spreads as compared to their historical ranges appear to predict higher frequencies of subsequent market downturns in monthly data. We construct horse races between switching strategies based on extremely low spreads and the market index. Switching strategies call for investing in the stock market index unless spreads are lower than predefined thresholds. We find that switching strategies outperform the market index in the sense that they provide higher mean returns and lower variances. In particular, the strategy based on the spread between the EP ratio and a short-term interest rate comfortably and robustly beat the market index even." Pretty hard to read, right? So you can only imagine what it's like to read this paper, even if you had a doctor in economics and finance. No wonder very few traders actually manage to fight through this stuff. And now, don't worry, I'm not gonna bore you with all the details here. I'm only going to show you the very juicy stuff that I have found in all of these papers, which give the long-term investor a lot of fundamental backdrop on how to predict bottoms and tops. Two things I want to mention here. One, it now makes sense that the Federal Reserve buys low and sells high, right? They understand the game and they believe in market timing. And secondly, what really got my attention is that most of the time the Fed papers revolve around earnings per share ratios or EP ratios and interest rates. In other words, yield curves and PE ratios. So these are clearly two fundamental factors we're going to pick up at some point during this course. We're going to talk about yield curves in this lesson, and PE ratios will be important once we move over to our yearly stock selection lesson. Before we do that, I want to spend some time to talk about tops and bottoms and their general characteristics in terms of the underlying conditions that are in place for a top and for a bottom. And these conditions differ. So usually we would have a bull market that keeps going and continues on and on and on without an end ever in sight, just like the green line you can see right here. Then oftentimes you have a little bit of a drop with supply being formed at the top, a rally-based drop. And for us, that would look a lot like a beginning of a bear market maybe, right? So we would be looking to do what? To sell. But here's the deal. How often does it happen that price just goes into another high, completely taking out the supply that was formed in the process? And this is repeating over and over. And that also makes sense because in the last lesson we talked about the big picture trend of stocks. It is an uptrend. So every time we are shorting, we are trading against a bigger picture trend, against this natural force, this gradual upward drift of price. And then after a while, stock markets finally bust, almost out of nowhere, and make a lower low. And from there, it just all falls apart. It goes very, very quick and drops like a hot knife goes through butter. And then, as quickly as it dropped, it rallies back up, creating almost like a V shape in the charts. So what we can see here is that supply in stocks during a bull market are very, very tough to time, especially when trading all-time highs, which you guys that have been following me for quite some time in the live trading sessions know I'm not the biggest fan of. And that is simply because of that phenomenon. This only applies to stock markets though. Supply doesn't have a very good track record as, for example, buying in demand. That's just statistics, and you'll be able to find the same result when you backtest supply and demand in stocks yourself. What can we learn from all of this though? Let's start with tops. Tops are processes that can drag on for a very, very long time, like we have basically seen since late 2017, where the markets are basically moving within this bigger time frame megaphone. Now here's the interesting deal. The point is that we need fundamentals to time a bear market or a market crash, really looking at market conditions, fundamental market conditions. In a bull market, market conditions are usually good and all of a sudden they become bad. And then the market figures it out at some point and there's a market crash. And then markets would crash until stocks are very valuable, or in other words, very cheap. And that brings out all of the buyers and they buy, which then causes this bungee effect of markets just rallying back up. Interesting observation, isn't it? And that's why market tops take so long, because it takes a very long time for the economy to fall apart. But it happens very quickly for prices to go back into a level of value where these stocks become cheap in the long run. So in other words, monthly high quality demand levels. There does not have to be any fundamental condition in place for bottoms. All that needs to happen is that there should be value for the longer term investor. In other words, cheap prices because they will come in and buy thinking that in the long run things will get better, because they always have. And the way how we would spot that is by simply looking at high quality monthly demand. The takeaway here is that stock market bottoms and tops are very different in the way they set up in terms of the underlying market conditions. So we are not going to look at the stock markets and stock market prices to call stock market tops. We're going to look at economic fundamentals that have an extremely good track record of timing these. In other words, we're going to look for indicators that predict recessions, because recessions lead to bear markets. Now we're talking. And even though bottoms are technically a lot easier to spot, they're emotionally very hard to time, because we have this cognitive bias and we have to buy when everyone around us, including us, is as bearish as we can get. We have to be able to buy into weakness, ignoring our emotions and buy monthly demand. And to help with that, I'm going to introduce a technical indicator, and I call this the Campus Buy Signal. And this indicator will help us massively in buying. So when it comes to timing tops, we do not want to predict stock market crashes by looking at stock prices. We want to predict recessions because we know recessions lead to bear markets and then stock market crashes. And let me tell you this before, it is possible to predict recessions, and that is where the Fed papers will come into play. They do not predict it tomorrow or the next day, and sometimes they give you a warning sign early. But here we would rather be too early than too late, since we would be talking about retirement funds and wealth funds, which should be invested in a safety first approach, especially the older you become and get, because you may not be able to catch up to a market crash if you are about to retire. Here is the first indicator I want to share with you today. And again, this is what the Fed looks at and is available at the Philadelphia Fed homepage. This is the so-called anxious index. The best explanation for what it is can be read on the Philadelphia Fed homepage. This anxious index basically portrays the probability of a decline in real GDP as reported in the survey of professional forecasters. The survey asks panelists to estimate the probability that real GDP will decline in the next quarter, in which the survey is taken, and in each of the following 4 quarters. For example, in the survey taken in the third quarter of 2020, the anxious index is 20.4%, which means that forecasters believe there's a 20.4% chance that real GDP will decline in the fourth quarter of 2020. And guess what? All the gray lines here are recessions. And not only recessions, but also bear markets. And when this index gets to about above 30, the red line I put into the chart, a recession is just around the corner. For example, this indicator would have flashed red in 2001 and mid-2007, allowing you to get out of your positions ahead of the major crashes. Now granted, this time around in 2020, it did not give us any headwind in what was about to happen. But there's more than just one indicator that we will look at. And if any of these flashes red, it gives us a warning sign that would say, hey, let's be more careful. Let's use tight stops and protect our running profits. And now this index is low. It could be lower, I know, but if this is back at the bottom in 2002, guess what? We really want to be buyers, right? Like in 2015, there were a lot of people that called for a recession and a market crash supposedly just to be around the corner. But look at this. There was no recession in sight. This was as low as it can get. So it works both ways. And to understand that, you don't even have to take an economics class or need a doctorate degree, because the Fed basically puts this on a golden platter for us. And that's all it is. This one right here is another interesting fundamental indicator to predict recessions. And you probably knew this was coming. The yield curve. And by now, we have already talked extensively about the yield curves in the Forex course and what a healthy yield curve looks like versus one that's unhealthy and the reasoning for that. So I'm not going to cover this here again in too much detail. If you have not seen it, make sure to watch the 2020 Forex course module 4 lesson 5. What I am going to do is show you how to read this chart, because it is one of the most relevant fundamental indicators in predicting future recessions. The Fed calls this treasury spread. Of course, they have these fancy names, but if you look at this right here, you will notice that this is simply the yield curve and the spread between the 10-year treasury note and the 2-year treasury notes. Exchange spread for difference, so the difference between the two, and when the yield curve was inverted, meaning the short-term 2-year treasury notes had a higher yield than the longer-term ones, this was a warning sign for a coming recession. This tool right here predicted the previous 7 recessions way ahead of time. The yield curve was inverted already back in August 2019, There was not even a coronavirus back then. Leading up to the housing crisis, the yield curve inverted in 2006, and leading up to the dot-com bubble, it inverted in the year of 2000. So here again, sometimes a little bit early, but who cares? This gives us a huge edge in long-term investing, and the yield curve goes through the same story every time. It inverts, then it matters, and then markets continue to rally. Everyone forgets about it, like this time it's different, and then all of a sudden there's a recession that no one saw coming. I think you're starting to get a better picture of why we were so bearish in 2020, right? Overall, ripe conditions for something like the corona crash to happen in terms of the decennial pattern, the cycles, and fundamentals. To take this thought further, here's a summary of the yield curve data, telling you when to be invested and when not to be invested. Whenever the yield curve is positive, it means that big money is fundamentally bullish, thinking that the future will be better. Whenever the yield curve is flattening, it is an indication that there may be difficult times ahead in the long run. For the short-term investor, this is still bullish though, but not as bullish as a positive one that is sloping upward. And when the yield curve is negative or inverted, it indicates that a recession is just around the corner. So this is the time to be short-term bearish. And it gets better. I'm now going to show you an amazing tool called the Dynamic Yield Curve, which you can use for free on stockcharts.com. They are really doing an awesome job in tracking the yield curve dynamically. On the right side, I have the S&P 500, and on the left side, the dynamic US yield curve. Now, what's really interesting, if I move this red vertical line here on the S&P 500, I can see the yield curve dynamically moving to what it looked like on that specific day. And this updates every single day. Now watch this. This is really some powerful stuff to the longer term investor. Let us start all the way to the left, looking at the year of 1999. A positive yield curve just implies that the short end is lower than the long end. And it is in this case. However, it is also flattening here, right? So we are still bullish short term, also understanding that there is some uncertainty in the longer run, what we now know to be the 2000 dot-com bubble. Let us take a screenshot of this and move the vertical line further to the right to see what happened over time. The yield curve was further flattening until 2000, and in the year of 2000, the yield curve inverted. Now, this is what an inverted yield curve looks like. The short end is higher than the long end, so short-term interest rates are higher than long-term ones. This means that investors are demanding higher interest rates or returns right now because they're worried about the future. Hence, this tells us that big money is frightened of the longer-term economic outlook. This right here predicted the 2000 dot-com bubble. So looking at our cheat sheet here, when the yield curve inverts, we want to be bearish and look to sell. Again, let's take a screenshot and move this vertical line further to the right. So now we can observe how the yield curve slowly normalized, and we would begin to be bullish again. Now see what's happening at the bottom of 2003. The yield curve has fully recovered and is extremely bullish. This is what a bullish, positive and upward sloping yield curve looks like. Also, let us compare these two data points with the decennial pattern. In 2000, the decennial pattern would have told us to be bearish, just like the inverted yield curve. So we would really be bearish here. And in 2002, years ending with 2, the decennial pattern would have told us that there's likely a new bull market happening. And we have a nice positive upward sloping and healthy yield curve. So here we want to be bullish. Sounds easy enough, doesn't it? So let us continue with this exercise and look at the next cycle. A bull market starts and we move higher. The yield curve remains to be positive and healthy for a long time. In 2004 and 2005, the yield curve starts to flatten, but it's still positive. Do we worry too much? No, we don't. Also, the decennial pattern, years ending with 5, would have told us to be really, really bullish here. So we stay invested, but rather shorter term now as opposed to longer term. And wow, look at this. We're now approaching the year of 2007. The yield curve is again inverted. At this stage, we're going to be bearish. This does not tell us right now to sell or to sell tomorrow. It simply gives us perspective on whether to be long-term bullish or bearish. And here clearly big money is bearish. The markets continue to move higher though, but the yield curve remains inverted and flattened. And while the yield curve seems to be normalizing at the peak of 07, we know that the recession has not yet happened and is likely to follow. And also the decennial pattern, years ending with 7, are usually bearish years. So we are really going to be bearish here still until we see a correction. And of course, once again, the markets fall apart. And in 09, we can see the yield curve has fully recovered. But we are really going to be more bullish only in the years ending with 2, right? So markets bottomed, really nice bullish yield curve, and it remains to be bullish all the way approaching 02. 2012. So if we are not yet invested in the long term, now's the time to pull the trigger. And we would go into a very long and major bull market. We can lean back, relax, and let this play out. Now, once again, the yield curve is flattening a little bit, but it's still positive. Do we worry too much here? No, it's a year ending with 5, the strongest year on average, 2015. We continue to be bullish up until 2017, which we know may be bearish in terms of the decennial pattern. So we would start to be a little more cautious here in 2017. Also, 2017 was post-election year. And we know that post-election is usually really bullish for markets. 2018 comes along, the yield curve is still flattening a lot now. And we can probably expect a negative yield curve very soon. As of now, this hadn't happened yet though. Only in August 2019, we could observe the negative yield curve. And for us, this is a sign to be bearish, really bearish. Also approaching 2020, which is also bearish in terms of the decennial pattern. And what we see is markets crashed. This time around really hard and quickly. And all of a sudden, the yield curve normalizes already in April 2020. Now, for as long as the yield curve is bullish, also we should be bullish. We have February 2021 post-election year seasonality coming up, where we expect bullish price until at least July or August, followed maybe by a little correction or a sideways move into October, November, from which we would be super bulls if the yield curve is still positive by then and the trend is still intact, because then we would almost be in 2022, which is very likely the start of a new bull market. I want to spend one more minute on this, really summarizing the key takeaways for the yield curve. The yield curve is fundamental on how the markets move. It tells us what big money is thinking. Is big money frightened of the future, neutral, or not worried at all? A steep rising yield curve with this upward slope is really bullish because investors expect strong future economic growth. And when the yield curve is inverted, sloping down to the right, where the short end is higher than the long end, that's bearish because investors expect sluggish economic growth. And when the yield curve is flat or flattening, this usually indicates that investors are neutral or unsure about the future economic growth. So the yield curve can predict recessions. In fact, the yield curve predicted the last 7 recessions in advance, and therefore we can predict tops and market crashes. The yield curve is more powerful in predicting recessions than bottoms. Remember, tops and bottoms have 2 different conditions. the additional indicators we use to time market bottoms, I will show you later in this lesson. I want to show you one more fundamental indicator to time both tops and bottoms, after which we're going to focus on when to buy. The unemployment rates. So we have the GDP declines with the anxious index, we have the yield curves, and the unemployment rates. This is a fundamental indicator I really like to predict recessions and recoveries. What I'm looking at is the employment trend. What you see here is the Conference Board unemployment data. They offer this data for free to download every month. So this takes a little bit of housekeeping in terms of new data, and what you see here is just created using my own Excel skills. The data points we get from going back all the way to 1980 is mind-blowing. So every time we go below a 20-point moving average on the monthly employment change, the red line, we saw stock market declines. And every time we move above it, stock markets rally. In this chart, I marked all the crossings, including the respective dates, which you can see market up right here. So March 1992, buy point, December 2000, sell point, November 2003, buy point, and so on and on. Now I want to transfer these dates over to the S&P 500 chart to show you how this translates to stocks. Would you have liked to buy in March 1992? This happened right at the beginning of one of the biggest bull markets ever recorded in history. Well, the employment report would have helped you to buy as employment was moving above the 20-period moving average. And we could have held all the way until December 2000, because this is when employment trend shifted. This accurately timed the recession and what is called the dot-com crash today. And only in June 2003, the job markets were recovering, and with that, the markets went higher. This time only for 4 years, until once again the moving average crossed in August 2007. Wow, once again, this is the time to get out of the markets, find a door and run. And in March 2010, once again, it would have been time to step back in. How fascinating is this? And this is pretty powerful information, because all this time we're trying to find stock market bottoms and tops by looking at prices only, while in fact we should be looking at fundamental drivers for stock prices. This is truly one of the greatest fundamental buy and sell signals in the financial markets to predict recessions and market recoveries. When price goes below the average line, it means that people lose jobs, right? The economy is slowly falling apart, and shortly after, stock prices start to come down. When price goes above the average line, it means that people go back to work. The economy is recovering. Stocks usually have already started to rally by then. Again, fundamentals of this genre have to be extremely relevant, because jobs are a driving force for every economy. And historically, a moving average on job numbers is just much more powerful than a moving average on a daily candlestick chart of, let's say, the S&P 500. Because while price can go above a moving average, it can also quickly go below it in a hurry. Those moving averages on S&P 500 are just numbers, but jobs do not change the directional course very often. And when they do, we really have to pay attention to what's happening in the economy. Now, again, this indicator did not give us a sell signal prior to the Corona crash, and that's fine. That is why I'm giving you more than one indicator, because the economy is a really complex construct and every recession is different. Therefore, we have to track several fundamental drivers of the economy, GDP, unemployment, and the yield curve. And if one or two flash red or green, that is enough confluence for us to change our perspective on the market. At the moment, employment has still not come back above the 20-point moving average. Stock prices usually already bottomed before that though. This is just due to the nature of stock market bottoms. They happen because of good value, and usually good value is only reached when everything is at the worst point of the recession, and only then things get better. How do we use this data moving forward? Well, if this chart does go above the moving average in and around 2021 or 2022 or 2023, and there's a positive yield curve, well, people, it is definitely time to buy long term. And by now, we're pretty good at understanding when to sell, go short, or be in cash. We have the Daniel pattern, the dynamic yield curve, the anxious index, and the employment trend. All of those give us a pretty good idea on when to find the doors and leave the room. But what about buying? Buying into weakness is a lot harder emotionally than selling into strength. As we observed before, when markets bottom, they come shooting back up, and they do that in a hurry. And when they do bottom, everything around us is so negative. This is something that, especially this year, I spent a lot of time researching and backtesting to find an additional tool that will take the emotions out of the picture, to have some objective data that tells us mechanically to come in and buy stocks, whether we like it or not. You have probably all heard the statement before, don't fight the Fed. And this is especially true today. So we have to be looking at indicators that the Fed looks at to decide whether they are going to go step in and take action. Therefore, we have created an indicator that looks at the 13 weeks rate of change. It is really simple. It says that if in the last 13 weeks prices are negative by minus 15%, I want to buy stocks. There are examples going all the way back into the 1930s, and I've done a lot of backtesting on this. And let me tell you, this works pretty damn well. But before I go into some of the examples of today, let's first talk about this magical number of 13 weeks. Why 13 weeks and not 12 or 14 or 15? The 13-week period is important because they represent quarters in the year. And quarters are important in the stock markets because they represent earnings announcements. So that is why the 13-week cycle here is the most important one to look at. This indicator allows us to buy into weakness, which is otherwise extremely hard for us to do emotionally, having this negative cognitive bias. Here you can see the S&P 500 chart and the Campos buy signal in blue just below. Now this indicator looks at the current week and compares it to the prices of the stock market 13 weeks ago. And if this is 15% lower than 13 weeks ago, we want to go in and buy stocks. Just like any indicators, sometimes they're a little early, but most of the time they work pretty well, especially when you combine them with supply and demand. You will see that this happens very, very rarely, and when it does happen, we know that things are pretty bad. And if we know that things are pretty bad, then our friends at the Federal Reserve are probably going to get a little more worried about the markets. And based on the evidence in the past, they are probably going to start to be more active because they do not want to see prices get that negative that quickly. So that is why this indicator would set up a buy signal for us. Just like any indicator, we do not just blindly go and buy once this flashes red. This is a setup tool, not a timing tool, meaning it gives us perspective to be more bullish. So here are some examples. Now, I like to look at all of the US major indices and ideally want them to be flashing green all at the same time. On the S&P 500, look at this right here. 1998 set us up for a pretty nice rally all the way into the 2000 dot-com bubble. Price was also in monthly and weekly demand. What a great area to look for a longer term buy opportunity. And then we don't see this happening until 2001, right after the crash. And again, a nice short-term buying opportunity here too, even though we probably wouldn't have bought just because there's no demand at this area, maybe with price action reversals. Anyways, in 2002, this indicator would have once again flashed green, giving us the low of the dot-com bubble, after which price rallied all the way back into the previous all-time high. And then we don't see this for another 6 years. Again, very rare occurrences which we want to take advantage on when it does happen. In 2009, this indicator would have told us to look for buying, timing the low of the high housing crisis. Nice weekly and monthly demand, trap areas, and if we weren't long by then, we would have looked for a long approaching 2012, years ending with 2, when this indicator flashed green once again, while markets were rolling over and price being in weekly and monthly demand at the time. Perfect timing, all stars aligned here. Oh yeah, of course, 2012, also a decennial pattern. to start looking for a new bull market anyways. What a coincidence. So here the market set up perfectly for a buy, monthly demand, decennial pattern, healthy yield curve, 13-week rate of change indicator, and voila, the rest is history. Next time we only see this 7 years later in 2018, and once again giving us a nice buying opportunity. And the latest example being March 2020, also predicting the low of the Corona crash right within monthly demand. The Dow Jones looks very similar to the S&P 500, and the Nasdaq is also very interesting, being the strongest index of today. Clear uptrend 2016, 2018, 2020 after the Corona crash, giving us beautiful buy signals using this indicator. So clearly this works pretty well, especially with a confirmed uptrend like we do have on the Nasdaq. We can also apply this indicator to just about any stock chart we want to, whether you are talking Amazon, Netflix, Spotify, or Apple and Alibaba. Ones that you can see right here. Again, uptrend, higher lows, and every time this thing flashes green, we have to be buyers big time, whether we like it or not. Whether you're interested in buying, we can use this indicator as an additional tool to help us buy into weakness. Why do I love this indicator so much? Well, because it really allows us to buy into weakness, which is otherwise extremely hard for us to do emotionally, having this negative cognitive bias. Why do we like all of these indicators that we spent more than half an hour on today in this lesson so much? Well, because they help us make data-driven, objective, and mechanic decisions in the marketplace. These indicators have a better track record than anything else I know or the Fed knows. So I'm just going to follow that. We could be wrong or we could be a little early, but on balance, nothing has done better. Therefore, these economic indicators, some of them provided to us for free by the Fed, will help you to forecast the future. And guess what? This doesn't only apply to trading stocks. This helps you if you're into real estate, because you know a deflationary period of a recession and a stock market crash can also cause housing prices to go down. This helps you with general investments or businesses that you may own or manage the future and to manage the future more effectively. So the beauty about the stock markets and what you guys are learning here is really that it gives you perspective for so many other fields in your life. And you don't have to look at these indicators every single day because they do not impact the markets every day. We look at this occasionally. I probably look at this more often than you do because that's just what I do. That's my job. But you can just look at all of this maybe once a month. Now the Campus Buy indicator you can simply download from the Classroom Notes section, save it under the relevant TS indicators folders in your documents, and your TS should automatically see this the next time you run TradeStation. Have fun backtesting. I know I spent hours, days, and weeks on this. All right, everyone, this is the end of this lesson. It was a long one. Up next, beating the market. Until then, thanks everyone. Happy and safe trading, and ciao.